Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, my name is Audrey Goh. I run the Thematic Strategy and Asset Allocation Division at Standard Chartered Bank. Welcome to Talking Thematics, a series of conversation where we will discuss about future trends, big ideas, or themes that will shape our investment future today and for many years to come. For this episode of the podcast, I'm going to talk about climate-related investments. And this year so far has been a rather disappointing one when it comes to clean energy equities and those relating to energy transition. Despite a year of very strong global momentum towards net zero, the performance of clean energy equities have been rather disappointing. This was due to rising bond yields, which have weighed on valuation multiples, and at the same time, clean energy companies have also under-delivered on profit expectations. Valuations have derated lower since January last year, and investors have now recalibrated their expectations with negative earnings revisions seen over the last few months. With oil prices now breaching over $100 per barrel at the time of recording, traditional energy have instead outperformed clean energy shares by some 30% year to date. And this outperformance is even wider when compared against oil price, which was up 30%, while clean energy shares was down by 15% in the last 2 months alone. Underinvestments in oilfield developments have constrained oil supply, while economic normalization have resulted in a surge in demand, driving oil prices higher. Certainly, the rising geopolitical tensions between Ukraine as well as Russia have also contributed to the higher oil prices today, though it may counterintuitively actually be a positive development for clean energy. We believe that it will likely encourage Europe to double down on their efforts to accelerate the development of clean and renewable energy grid and reduce their gas dependency from Russia. While the traditional oil companies are reaping record profitability from this recent surge in oil prices, whether these carbon-based investments represent good value today or ultimately become a stranded assets over the longer term as the world shifts towards clean energy sources is a question mark. Only time will tell if the current momentum on fossil fuel will prevail. And after a year of sharp price decline, valuation of clean energy themes have come off quite sharply to about 25 times 12 months forward earnings per share from about 44 times during its peak in January 2021. In the meantime, the momentum to net zero continues, and both investors and companies are aligning themselves with the regulatory-driven Europe taxonomy. This will help prevent greenwashing and drive investors towards companies which are genuinely exposed to sustainable and clean energy activities. The IEA expects the share of clean energy in global electricity production to rise from about 20 to 30% today to more than 60% by 2030. And this long-term tailwind of adoption will be beneficial for clean energy companies. In the near term though, we would watch out for any small positive policy surprises in the form of a US climate bill or potential easing off of some of the macro headwinds from an aggressive Fed. This could well provide support for some of the climate-related assets over the coming months. And like I always say, all things being equal, a cheaper valuation today likely increase the probability of positive future returns for longer-term investors. This is Audrey Goh signing off on Talking Thematics Episode 2. If you've enjoyed what you hear, please do like, share, and subscribe to this podcast. See you next time.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.